Well, hello everybody. This is Ken Himmler, and I'm here to give you a message about what is going on with the stock markets, the bond markets, interest rates, inflation, and help you really understand what is actually happening and why much of the media that we are reading and seeing today should be ignored. And let me go through some statistics with you and put your heart and your mind at ease that the world is not coming to an end. The sky is not falling. Chicken Little has not shown his face recently. But let me go through a couple things with you, because this recent interest rate increase is really in conjunction with the free money that the government continues to give out. There is one reason for inflation, and that is because when the government just spits out money and makes it easy for people not to go back to work, and they basically are giving handouts, it will increase inflation because people have free money to spend. Billions and billions of dollars were given out during the pandemic. If you study what happened in 1918, 1919 with the flu epidemic, and when people got out of the lockdowns that even happened back then, they went spend crazy. That's why they called it the Roaring Twenties. We are going through this same evolution right now. But I want to outline a fact. Back in the 20s, people went spend crazy. And then when the 1929 stock market crash happened, there were actually more millionaires made per capita during that period of time, because certain people are smart about their money and certain people make emotional decisions based upon hype, incorrect information, and manipulative information. And what I mean by that is, if you read the newspapers, newspapers are showing my age there, right? The internet now is, the delivery of choice. You'll see a lot of information out there about the world coming to an end. And I'll give you a perfect example of that. Robert Kiyosaki, who I at one time respected because I thought he had put a very good book together for basics, which is Rich Dad, Poor Dad. However, Mr. Kiyosaki has learned that he can make a lot more money selling and speaking at seminars, and then selling as an actor, basically. And if you read his things now, the world is coming to an end. Everybody should invest in gold. Well, that's because he's selling gold seminars. And he has an inherent interest towards swaying you and what you think about Robert Kiyosaki and what the future holds. And then you have people on the other side of this situation, which guys like Bill Ackerman, who runs the multi-billion-dollar Allianz hedge fund, and he made predictions that were back in the middle of 2020, where he stated that the world is coming to an end. And because people thought this guy knew what he was talking about, what they didn't know is that he was hedging the market. What that simply means is that when you buy a stock or an investment, it's called going long. It means that you're invested in the long term, like a Warren Buffett mentality. If you short the market, you're betting, and I really use that word, betting, and that's the difference between investing and betting, is when you try to time the market. When you try to figure out what's going on in the short term and make maneuvers, either because you think that the world is coming to an end. Some people think that they can outmaneuver the market, outthink it, outcalculate it, read enough information and figure out what's going on and make the right moves. Statistically, you have less than a 1% chance of succeeding. But Bill Ackerman will make it even harder, because this guy in 2020, he made a prediction that the world is coming to an end. He was shorting the market. That means that he had bought puts and he had bought shorts, which when the market goes down, you make money on those. So he created this fear. People sold. He took a $4 million or a $25 million investment and turned it into $4 billion. That's how it works. So the reason I'm putting this together is so that you understand really what is going on in the market. Now, you're looking at a guy that has done this for 40 years, and the game is always the same. Media steps in. Media is promoted by financial institutions. Financial institutions will make money whether you buy or whether you sell. When they do not make money is when you hold on to things. So if you wonder where all this media misinformation comes from, turn on any financial news station. And it used to be, it was the financial magazines where, they would give a piece of advice and then you turn a page and then there's a full page ad from some mutual fund company or a variable annuity company or 401k. But the bottom line is, it's now on the internet or it's on a TV channel. It's on a streaming cable channel. And they'll make a prediction and the world's coming to an end, and they even have this ticker going across the bottom all the time. And then you'll see a financial ad. Listen, these financial institutions want to play the mind game with you. They want you to go into fear. And they want you to go in fear because you'll sell. And every time that you buy or sell, a financial institution makes money. It's called the difference between the bid and the ask price. You may not see it, but market makers make tons and tons of money, billions of dollars. This is why when you look at companies like Goldman Sachs or Wells Fargo or any of these Merrill Lynch, and they're called market makers, whenever the market moves in giant ways, they come away with giant profits. So what I'm trying to help you understand is we are not in a new world. We are not in a new evolution. We are not in a new economic time. The bottom line is we are doing what we always do as humans, and we are repeating history. And I want to show you what I mean by that. During the June drop, I didn't get as many emails and concerns and worry about the market. But with the news of inflation and the news of interest rates going up, it seems like people's fears are even more ramped up. This is normal. What's going on right now, it's normal. It has happened in many instances in history. It will continue to happen. If you have the 3-bucket system that we created, what you're looking at is the major volatility is inside of that third bucket. That's the 10-year bucket. So while you might look at a statement or you bring up your e-money and you might say, oh, I am down by this much, don't use the words I lost this much, because you didn't lose anything unless you make a bad decision. And that's what I'm here to hopefully help you prevent. You don't lose until you sell. We have reverse engineered your plan to assure that you have steady and sustainable cash flow for the period of time of 10 years. That allows all of this short-term hype, volatility, craziness to work itself out. Unlike most financial institutions who make more money on the growth mutual funds, the international mutual funds, the high volatile stocks, because they have either higher fees or they're making that bid and ask difference, the profit, the commission, on the difference. Now you might say, well, wait a minute, I'm with XYZ and they don't charge us any commission. Well, they don't charge you any commission on top of the difference between the bid and the ask, but every single time any security is sold, there is a difference between what retail and wholesale buys and sells. And whoever's holding those positions, they would love it if you sold, because they're going to make a commission. You just don't see it, but you can look it up. You can look up any ETF or stock or bond, and you can look at the difference between the bid and the ask price. And that is what the financial institutions want you to pay them. And they only will earn that if you sell. So let's talk about really where we're at. I mean, if we look at this and we say, hey, where are we year to date? Well, you can see it on your screen. We're down 20.99 on the S&P 500. Remember, this is not your whole portfolio. If you have the 3 buckets, depending upon your cash flow. Now, I will say trusts, certain trusts, irrevocable trusts, and certainly charitable remainder trusts are very different than this discussion, because a charitable remainder trust is not reverse engineered under the 3-bucket system. It is more of a tax allocation strategy. But if we're talking about a Roth, we're talking about an IRA, we're talking about a revocable living trust. Those are all into the three bucket system, reverse engineered into cash flow for 10 years. As you can see, in the last 9 months, we're down 20%. Again, we've been through this. If you've been with me for any period of time, if you've been with me for 20 or 30 years, we went through this in 86, 87. We went through it in 99 with the tech crash. We went through it in 91 with the bond crash. We went through it in 2006, 7 in the Great Recession. We went through it in the pandemic. This is all just history repeating itself again. Okay, let's take a look now at 1 year. 1 year, we're down 13%. Again, no one's portfolio, and you've probably heard me say this before, we never design anything to make a fixed payment, i.e., your retirement plan or your retirement income, from a variable investment. That's why we use the three bucket system. That is if you are in the distribution phase. Now, if you are in the accumulation phase, meaning you don't need this money for a period of time, you might have a lot more allocated to the bucket 2 and bucket 3, and you're going to be a lot more volatile because you don't need the money. If you don't need the money, there is no reason to worry about it. I get this question almost every day. Ken, are you looking at your own portfolio? No, I'm not. I know exactly how it's designed. I know exactly how it's engineered. This short-term bouncing is really what Warren Buffett calls Mr. Market or Mr. Manic Market. And Mr. Manic Market is this guy, and he's a little bipolar. And he gives the example of one day he wakes up, he's happy. One day he wakes up, he's sad. One day he wakes up, he's angry. There's just no way to tell what he's going to do on a daily basis. If you try to figure out what mood Mr. Manic Market is going to be in, you'll never outguess it. Now, I have a lot of people say, well, I'm not a market timer, but can I go to cash? I hate to say it, you're a market timer. What should we do as this market is sliding down? If it was originally designed and engineered correctly, there's absolutely nothing that you should be doing. It is already built into the system. So Mr. Manic Market is when people are trying to outguess. What are they going to do with interest rates? What are they going to do with inflation? What's the stock market going to do? What's the housing market going to do? So you can never determine that on a short-term basis. Even if you've attended any of my Wiser Money shows, I'm building those algorithms 3 years out, which is why a lot of people say, well, what's going to happen in the next 6 months? I have no idea. But I can at least give some relevance of an algorithm for 3 years out. So this short-term market volatility is, again, not something that I am concerned about in any way, shape, or form. Now, you want to be concerned about something? Nuclear war. If Russia launches some missiles, yes, that is something that would certainly concern me and certainly concern the long-term viability of anybody's economic situation. But assuming that doesn't happen, does this inflationary increase, this interest rate increase concern me at all? No. And let me show you why. And this is where people are missing the boat. They're so short-sighted. I wrote a letter to a client, and I tried to explain this. And I'll tell you the same story. It was about a decade, maybe more ago, and I got to drive one of these race cars on a racetrack at Daytona. And I don't know what I got up to. I think it was 120, 150 miles. It was just fast. And as I was going around the track, and of course I had a professional driver right next to me, instructing me. And, I started getting nauseous. And I said, hey, what's going on? I am sick to my stomach. He goes, lift your head up. Look 4 feet more above the hood. So what I was doing, and he explained this to me afterwards, he said, I was trying to drive double the normal speed while using the same techniques as driving at 60 miles an hour. So when you drive 60 miles an hour, you're looking about a foot above your hood. But when you drive 120 miles an hour, you got to lift your head up 3 feet to 4 feet higher. The road comes at you that much faster. So the reason that a lot of people are getting nauseous with this market is they're looking too far down on the hood. That's short term. You got to look up a little faster or a little higher so that you can see the road coming at you from a longer distance. So what I'm saying is don't look 1 foot above the hood. The way you handle this kind of volatility and stress, you look 4 feet above the hood. Again, there are pandemics and there's war and there's all kinds of other things that can affect this. And if you look and say, hey, all those things change. Wars end, pandemics end, droughts end. There's things that end and then we go into different cycles. These cycles will always be here. So what I'm saying is do not get too tied up with what the media is trying to tell you to do right now, because there is a ulterior motive with that information. Let's look at 5 years. In 5 years, even with the inflation, the interest rate increase, even with the pandemic, you'll see there 51% rate of return over 5 years. That equates to about 10% per year. You do the numbers, right? So even over 5 years in this craziness that has happened over our last 3 years, we are still 10% average per year in the market. Now again, I'm not telling you to take the average of 10%, figure out how much money you have, retire, and assume you can get 10% from your portfolio. Because again, this is bucket 3 only. And as you see, it has to work its way out, meaning the averages. Because what would have happened if you would have invested your portfolio in December of 2021? Right now, you're seeing it at the top of the market. But if you look and you say, well, what would have happened if I would have invested at the top of 2019, the end of 2019, right? You'll see that on your screen, and I'll just bring the mouse here. You see that right there. Then the pandemic hits, right? And then everything drops. And if you have the Chicken Little effect, the world's coming to an end, you would have sold. But what you would have missed out on is that market almost doubled. Well, it did almost double, I mean, close to it, but it went up in a big, big way. It's now down again. If you would have invested in December of 2021, you would have been way at the top, and you're down. It's okay, because you should not be depending upon that money to live on. So again, 10% average rate of return over 5 years. You're seeing the secret sauce to the 3-bucket system. So let's look at the historical reactions to inflation. Well, we have this giant one here that happened in the 20s, i.e. the pandemic of the 1919 Spanish flu. Inflation went through the ceiling. Why? People were spending money like crazy because they wanted to get out, right? And then what happened? And then you see that giant drop in the 20s, and then it jumped up again. It jumped up again in the 60s, and then again, and this is I'll show you, there's 2 relative statistical, historical pinpoints, and that is the Spanish flu and what happened with inflation in the 80s. And we'll talk about that. So let's take a look at exactly how the stock market has reacted when interest rates go up. Let's take a look at this first period of time. I'm going to move the camera a little bit because it's right in front of the screen, so I can't read it with you. But you'll see there in 1998, year 2000, and the Fed fund rates go up. Do you see what happened right afterwards? The stock market drops. This is what's happening right now. But then what happened? Stock market went way back up. Now let's look at it again. In 06, 08, so we had our Great Recession. This was a period of time that was accelerated by banks' lax lending, and we had this blowout. Now, that's not much different than the government creating inflation today. The banks created the inflationary effect on housing in 2005, 6, and 7 because they lent too much. So what happens when you get free money? People spend it. There's a shortage of supply, high demand, because people have money, so people raise prices. When it gets out of control, the Feds step in, they raise rates. When they raise rates, the stock market drops, short term. Now look at what happens. If you look out in 2009, 2010, rates drop. Now, if you would have taken the Chicken Little approach, the world is coming to an end, it's the Great Recession, that's actually where we made some of our clients the most amount of money ever, is in that terrible period of time. Then what happens? Well, the market just soars through the ceiling. Why? Rebalancing. Let's take a look at what happened with interest rate history. So let's relive a little bit of this. We can look at this statistically from what happened in the Spanish flu and that inflationary period of time, but that is not as relative as the 1980s, and here's why. When we look at what happened in the Spanish flu, we had the human element of inflationary increase. We had the increase in interest rates, but we had no banking regulations. There was no FDIC. There was no Social Security. There was no Section 8 housing. There was no welfare system. There was no food stamp system. And the biggest thing that was missing back then is regulations on the securities markets. However, in the 1940s, they started really heavily regulating the security markets. So now what we see is in the 70s, early 70s, 72, 73, 74, the stock market took a tank, right? Short term. But again, you should never be depending upon the stock market, which is a volatile investment, to pay for fixed expenses. This is why we reverse engineer the three buckets. But if you look at what happened is inflation went crazy. And one of the first Fed chairmen, Paul Volcker, stepped in and he said, well, the only way we're going to control this is we're going to raise rates. Now, again, most of the people that lived through this might not be around anymore, but I can remember 15, 20 years ago, clients would walk in and they would say, oh, I miss those days of the 80s where I could go get a CD and that CD was paying, 14%, 15%. And I'd say, no, that's not a good time. And here's why. In that short period of time where you could have gotten a CD paying 15 to 16%, inflation peaked out in 1979 at 13.5%. So if you think about the dynamics, you have a CD, pays you 15%. You're going to give a third of it back to the government in taxes. You're going to net 10%. But inflation's 13.5%. You're still losing money. So the key is good tax management and making sure that you beat inflation. Sound familiar? Those are the times that we're in right now. So what happened was Volcker came in, he raised the interest rates to 19% because inflation was running Brazilian. If you ever hear me say that, it's because the Brazilian government has struggled with inflation for years. Matter of fact, they defaulted on a Social Security loan back in the 80s to the U.S. because inflation was so bad and their political environment was so bad. So if you hear me saying they're going Brazilian, it means that inflation's going wild. Too much demand, little supply, free money. This is how it happens. So what's going to happen is the stock market is going to drop temporarily until it rebalances itself. It's kind of like one of those little mercury switches where you balance it out and it recalibrates itself. That's what we're going through right now. But it's not something that you should take a action of moving out of stocks to cash or all into bonds or any of those kind of dramatic changes that you will read about in the media. So let's look at later what happens. So the stock market history, if you correlate the same period of time, Volcker raises rates, stock market does what? Drops. Inflation rebalances itself. And then what happens is the stock market rockets. Now, depending upon the period of time that inflation takes to rebalance, you do not ever want to be in cash. Why? The numbers are simple. The stock markets rebalance themselves. The stock markets mend and recover. Do you know what does not recover? Time. You're issued a certain amount of time in your life. When you spend that time, it's the only thing you can spend, and you can never re-earn. But that applies to inflation. So if you have $1 million sitting in a cash account because you decided to go cash, and it takes 1 year to 2 years for this to rebalance, and let's say that inflation's 9%, you've lost 18% of $1 million. You physically did exactly what you were trying to avoid by going to cash. You lost $180,000. Unfortunately, while the stock market can recover and you can make more money long term, you can never, ever recover that inflationary loss. It's done. Time is gone. So the key is you do not make these kinds of changes where you go to cash and try to time the market. So let's look at our actions. Number one, we are not going to cash. That's not going to happen. And why? I'm the navigator of the boat. I've been through rough seas. I've been through hurricanes. I've been through these things before, and I know exactly how they come out at the end. The last thing I'm going to do is turn my ship around when I see a storm and take it back to port. All I'm going to do is I'm going to go around the storm. We're just going to stay on track. We're going to get that boat to the other port. But we are not going to stop our journey. When people go to cash, they're literally turning the boat around. They have no delivery, no end result, no profit at the end. Instead of rebalancing. Now, there have been a couple times in history, and the most recent times I'll talk about in a minute, we go to what's called a drip skip. So a drip skip is a technique that is very well known as a drip. But what I term as a drip skip is when we skip the rebalancing. So rebalancing is when we design the three buckets. We have a certain allocation in three buckets. Within each bucket, there's a sub-allocation. What that means is if I look at bucket 3, which is the aggressive, volatile bucket that is designed to beat inflation. And remember, bucket 1 will not beat inflation. My target is for bucket 2 to equal inflation, and bucket 3 will beat inflation and allow us to replenish bucket number 1. Now again, if you're in the accumulation stage, we have a lot more allocated towards bucket 2 and 3 because we don't need to spend cash. We don't need to distribute money. So it depends on, this advice is dependent upon what stage of life that you're in. And there is a transitionary period of time. If you're 5 years away from the distribution phase, that's kind of a hybrid of how we design it. But if we look at the drip skip, what we're saying is within the buckets, there are all these sub-allocations. So I'll give you an example. If I look at bucket number 3, I have domestic large cap stock. I have domestic middle term. And the differences now is between small cap and mid cap are very gray, so I just call them mid cap. I have domestic REITs. I have international growth. I have international midterm. And then I also have bonds, but those are based upon maturities and issuers. So we have short-term, middle-term, intermediate term, and long-term government bonds. We have short-term, intermediate term, and long-term corporate bonds. We have national bonds or domestic bonds. We have international bonds. So there's all these sub-allocations, and as you've seen us do this in the past, we will do two techniques. One is tax loss harvesting, where what we're doing is we're taking one allocation, and it could be, say, small cap, and maybe that area is going down a little bit, and we will swap it for another small cap. That does not change our allocation. It's only taking advantage of tax rules. Then we have the second technique, which is a rebalance. A rebalance happens when we completely redesign the portfolio, and not redesign it. Let's say stocks go up, we'll sell some of the gains and take them off the top and put them into bonds because bonds have gone down. If bonds go up, we'll sell some of the bonds and take it and put it in the stocks. So we're always keeping our original target balance in those categories. Those are two of the most common techniques. We review that and do that usually every quarter. We're looking at those allocations. However, we're in an interesting environment right now. It's not pandemic related, which is just fear related. This is macroeconomic related. So we're not going to do what we normally do. We're going to use the drip skip. Drip skip means we are going to skip the rebalancing. We're going to keep the allocations and the percentages exactly where they are right now. But what we're going to do is turn on drips. What are drips? They're technically called dividend reinvestment plans. And what it means is that if a bond is, let's say, paying 5 or 6%, or 7 or 8 or 9, those dividends, which would normally come out in cash, they would go into the cash account. And then when we would rebalance, they would get reallocated between the stock and bond and REIT percentages. We're going to use a different tact right now, and I'll explain why. But that's what happens. When the dividends come out, they go to a cash account. The same thing with a stock. When there's dividends and they come out, they go to a cash account. What a drip skip is we're going to skip the rebalancing, and we're going to turn the drips on. What that means is we're going to code all the investments to say, don't put the cash, the dividends, into the cash account to allow us to rebalance. What we want to do is we want to rebuy shares of the existing accounts. Now here's one of the reasons why. Stocks right now are down, which means that the dividend rates are up. So you'll see your dividend rate as a percentage of the value go through the ceiling. Again, why would we sell something that was paying a 4 or 5% dividend and is now at 7 or 8 or 9% and take it to cash? It doesn't make any sense at all. And same thing on the bonds. So the bond values in an exchange traded fund, which is the only thing that we use. And let me give you the example of what that means. So an exchange traded fund, just think of a bucket. And in that bucket, there might be 500 or 1,000 different bonds that ETF issuer has put into that bucket. Now remember, with bonds, even though the exchange traded fund might say it's a middle term bond, intermediate bond, what that simply means is it's less than 5 years, could be between 5 and 10, or intermediate term, between 5 and 10 years. It doesn't mean that out of those 1,000 bonds, every one of those bonds has the same maturity date. This is why I highly advise you do not get pulled into the idea of going and buying individual bonds. It's too risky, and all your timing is based on your return. Your return is based on your timing. In addition, the brokers that sell those, even though they may not tack on a commission that you can see, there's generally between 3 and 5% markup, meaning you lose when you buy that bond. Versus when an ETF buys that bond, they're not paying that. They're paying wholesale and you're paying retail on the commission. So we can buy a basket of bonds, and within that ETF, every one of them is turning over. So if I buy an intermediate term bond, and let's say I have 1,000 bonds, every one of those bonds has a laddered maturity date. So I'm not stuck to one bond, one maturity date, one issuer. I have a multitude of bonds, which reduces my risk, and not only on default, but also on issuance. So there is a risk inherent in bonds based upon the date, the type, and the length of the bond that you buy. Well, we don't really get that problem in an exchange traded fund. Now, a lot of times people will say, can I do the same thing in a mutual fund? No, because when people get scared, the mutual fund manager has to sell the bonds, and that can lock in a loss. If we use a true pure ETF, now I know I have to say that now because many mutual funds are now issuing what's called actively managed ETFs, which have a lot of the same inherent risks as mutual funds. So I'm talking about pure ETFs. When we use those baskets of bonds are continually maturing. So think about it. If interest rates go up, the value of a bond goes down depending upon the length of the bond. But if I have all these bonds in there, I have all these different maturity dates and they keep maturing, then what happens is the bond, when it matures at par. So let me give you an example. You buy a $1,000 bond. Interest rates go up and maybe the bond drops in value. And bond drops to $900. That's if you sell it, which is why I don't use mutual funds. But if the bond value goes down to $900, it's only until it matures. When it matures at $1,000. So by using this laddered approach on an economically feasible basis through an ETF, we're able to get this diversification and this rotating ladder of bonds. That protects the downside, and it even protects the whole idea of interest rates going up, taking losses on bonds. But now what happens is we're going to have dividends come out. If we rebalanced right now because stocks are down, it would be buying the stocks from the bond interest. We don't want to do that because you go back in time and you said, what would have happened in 1980 if I would have bought a 20-year CD paying 15%? Well, when interest rates come back down, that would be a sweet deal, wouldn't it? Because you're locked in. You lock the bank in at 15%. And that's exactly what we want to do with this drip skip. We want to take those dividends. We want to reinvest them into the bond ETFs. As those bond ETFs within the ETFs mature, we're buying new bonds, but they're at the new interest rates and the new extended maturity dates. Okay, so it's a different strategy. Have I used it before? Yeah, but if I look and I say right now, I got short-term bonds that I could crank between 4 and 5%, and are mid-term bonds 7 and up to 9% on some long-term bonds right now, and stock prices are down right now and dividend rates are up, why would we push more into the stock market right now? On the bond interest. Let me clarify that. On the bond interest. Now, if we have stocks, we want to allocate those dividends to buying more stock shares. So we're hedging on both accounts based upon the graphs and the statistical data that I just showed you. The other reason that we do not want to rebalance right now, they're not done with rate raising. If we rebalance right now, we're pushing cash and bonds into the stocks when they've already claimed they're going to raise rates at least 2 more times and get that prime up to 4.25 to 4.5, sometimes, or even 4.75. So we already know what's coming. So the smart move right now is doing the drip skip. And we're going to take that interest and we're going to reinvest it. So the last 2 times I did this was 2008, because we had a similar situation with interest rate increases, inflationary increases. And the other time I did it wasn't so much for interest rate and inflationary increases, it was because of the imbalance that did not make sense to rebalance. And that was in 2015. Now, I want to clarify something though. For aggressive investors, we are going to be implementing a new strategy, not new, repeated, not used for a while, where we're taking the interest from the bonds and the dividends from the stocks, and we're using that to buy call options over 1, 2, or 3 years. Now, if you are in your accumulation stage and you are one of those, then you obviously will see what we're doing with that, but that will give us a higher potential for long-term growth considering where the market is today. And it's at a very low risk because we're only using interest and dividends. Okay? So before I wrap up today, I just want to go back, explain the best way to keep your stress down is not read the media. I don't. I look at the algorithms, I look at the actual macroeconomics as they apply, but all these gurus out there telling us the world is coming to an end, and we got to go to Bitcoin, and we got to go to gold, and look through what they're trying to tell you. These are statistical repeats of history that have been handled in a certain way in the past, and we're going to handle it the same way right now. So I would not get too worried about it. These are the times that we shine, because listen, if the stock market just keeps going up, that is one determinable rate of return. But when the greatest gains are made is when everybody else is fearful. If somebody doesn't get on that fear train and they understand the logic and the numbers, that's where the big money is made. With that in mind, enjoy this time. Time is not replaceable, and so I would not spend more time on watching the media, and hopefully this helped you out. Thanks for taking the time to listen. Take care.